Right now, you're probably sitting on cash that's losing value every single day. While you're debating whether to invest, inflation is quietly eating away at your purchasing power like a silent thief in the night. But here's the million-dollar question that's keeping investors awake at night. Should you put your money in gold, real estate, or mutual funds as we head into 2025 and 2026? The answer might surprise you, and it's definitely not what most financial advisors will tell you. By the end of this video, you'll understand exactly which investment could potentially protect and grow your wealth in the coming years. And more importantly, you'll know why timing has never been more critical than it is right now. Let me tell you about three friends who made three very different investment decisions at the start of 2020. Maria put $50,000 into gold, convinced that economic uncertainty would drive precious metals to new heights. David invested the same amount into a real estate investment trust, believing that property would always be a safe haven. And Sarah chose to diversify her $50,000 across several mutual funds, trusting in the long-term growth of the stock market. Fast forward to today, and the results tell a fascinating story about the nature of investing in uncertain times. But before we dive into who won and who lost, let's understand what we're really comparing here. These three investment options represent three fundamentally different philosophies about money and wealth. Gold represents fear and protection. Real estate represents stability and tangible value. Mutual funds represent growth and faith in human innovation. Each has its place in a smart investor's portfolio, but understanding when and why to choose one over the others could be the difference between financial security and financial regret. Let's start with gold, the investment that has captured human imagination for thousands of years. There's something almost primal about our attraction to gold. It's been a store of value since ancient civilizations, and it's one of the few assets that has maintained its purchasing power across centuries. When empires fell and currencies collapsed, gold remained. This is why many investors see gold as the ultimate insurance policy against economic chaos. Gold shines brightest during times of uncertainty. When inflation rises, when currencies weaken, when geopolitical tensions escalate, investors flock to gold like moths to a flame. It's what financial experts call a safe haven asset. But here's what many people don't understand about gold. It's not really an investment in the traditional sense. It's more like financial insurance. Gold doesn't produce income, it doesn't pay dividends, and it doesn't grow a business. Its value comes purely from what someone else is willing to pay for it. In 2024, gold reached record highs, climbing past $2,400 per ounce. Central banks around the world have been accumulating gold at unprecedented rates, and geopolitical tensions have kept demand strong. But here's the critical question for 2025 and 2026. Is this the beginning of a new gold bull market, or are we seeing the peak of a fear-driven rally? The case for gold in the coming years is compelling. Interest rates, while higher than they were during the pandemic, may start to decline as central banks combat potential economic slowdowns. Lower interest rates make gold more attractive because it doesn't pay interest, so the opportunity cost of holding gold decreases. Additionally, ongoing geopolitical tensions, concerns about currency debasement, and the potential for renewed inflation could keep gold demand strong. But gold also faces headwinds. As economies stabilize and growth resumes, investors may shift away from safe haven assets toward growth investments. The strong dollar, if it continues, could pressure gold prices since gold is priced in dollars. And perhaps most importantly, gold's long-term returns have historically lagged behind stocks and real estate over extended periods. Now let's talk about real estate, the investment that you can touch, live in, and drive by to check on. Real estate has been the foundation of wealth building for generations. It's tangible, it provides shelter, and it has historically appreciated in value over time. But the real estate market heading into 2025 and 2026 is unlike anything we've seen in decades. The pandemic changed everything about real estate. Work-from-home policies shifted demand from urban centers to suburban and rural areas. Low interest rates in 2020 and 2021 created a buying frenzy that pushed home prices to historic highs. Then came the Federal Reserve's aggressive interest rate hikes, which dramatically increased mortgage costs and cooled the housing market. Now, we're in a strange situation where home prices remain elevated, but transaction volumes have plummeted because existing homeowners are reluctant to give up their low-rate mortgages. This creates a unique opportunity and challenge for real estate investors in 2025 and 2026. On one hand, the limited supply of homes for sale could keep prices elevated. On the other hand, high mortgage rates make real estate less accessible for many buyers, potentially limiting price appreciation. The key question is whether interest rates will come down enough to reignite demand without causing a speculative bubble. Real estate investment trusts, or REITs, offer a way to invest in real estate without the headaches of direct property ownership. REITs allow you to invest in portfolios of income-producing real estate, from apartment buildings to shopping centers to office buildings. They're required to distribute at least 90% of their taxable income to shareholders, which means they often provide attractive dividend yields. But here's what makes REITs particularly interesting for 2025 and 2026. They're trading at relatively attractive valuations compared to their historical norms. The rise in interest rates has pressured REIT prices because these companies often carry significant debt, and higher rates increase their borrowing costs. However, this also means that investors can potentially buy quality real estate assets at a discount to their intrinsic value. The challenge with REITs is that they're sensitive to interest rate changes. If rates continue to rise, REIT prices could face additional pressure. But if rates stabilize or decline, REITs could see significant appreciation on top of their dividend income. It's a bit like buying a house with a variable rate mortgage. The outcome depends heavily on where interest rates go. Now let's explore mutual funds, the investment vehicle that has democratized access to professional money management and diversified portfolios. Mutual funds pool money from thousands of investors to buy a diversified portfolio of stocks, bonds, or other securities. They offer instant diversification, professional management, and the ability to invest in markets and sectors that would be difficult to access individually. The beauty of mutual funds, particularly index funds, is their simplicity and effectiveness. Instead of trying to pick individual stocks or time the market, you're essentially buying a small piece of the entire economy. When businesses grow and prosper, your mutual fund investments grow with them. Over the long term, this has been one of the most reliable ways to build wealth. But mutual funds face some unique challenges in 2025 and 2026. Stock market valuations are elevated by historical standards, particularly in the technology sector. The price-to-earnings ratio of the S&P 500 is well above its long-term average, which could limit future returns. Additionally, the end of the ultra-low interest rate environment means that bonds, which make up a portion of many mutual funds, may face headwinds if rates continue to rise. However, mutual funds also have significant advantages heading into the next 2 years. Corporate earnings have remained relatively strong despite economic uncertainties. Innovation continues to drive growth in sectors like artificial intelligence, renewable energy, and biotechnology. And the global economy, while facing challenges, continues to expand, creating opportunities for well-managed companies to grow their profits. The key to mutual fund success in 2025 and 2026 will likely be diversification and cost management. Broad market index funds that track the S&P 500 or total stock market indices offer exposure to the entire economy at very low costs. International funds can provide exposure to faster-growing emerging markets, and sector-specific funds can allow investors to capitalize on specific trends like the energy transition or demographic changes. So, returning to our three friends and their investment choices, what actually happened? Maria's gold investment performed well during the initial pandemic uncertainty, but then struggled as markets recovered and interest rates rose. David's real estate investment faced volatility as the sector adjusted to changing interest rates and work patterns. Sarah's diversified mutual fund approach weathered the ups and downs, but benefited from the overall economic recovery and corporate profit growth. But here's the crucial insight. None of them was completely right or completely wrong. The best investment strategy isn't about picking the single best asset class. It's about understanding how different investments behave in different economic environments and building a portfolio that can weather various scenarios. For 2025 and 2026, the optimal strategy likely involves elements of all three approaches. Gold can serve as portfolio insurance against economic uncertainty and currency debasement. A small allocation to gold, perhaps 5 to 10% of your portfolio, can provide protection without significantly dragging down long-term returns. Think of it as paying for insurance on your house. You hope you never need it, but you're glad it's there if disaster strikes. Real estate, whether through direct ownership or REITs, can provide inflation protection and income generation. Real estate often performs well during inflationary periods because rents and property values tend to rise with the general price level. For 2025 and 2026, REITs may offer better value than direct real estate ownership in many markets, given their current valuations and the challenges in the residential housing market. Mutual funds, particularly low-cost index funds, should likely form the core of most investors' portfolios. Despite current high valuations, the long-term growth potential of a diversified stock portfolio remains compelling. The key is to focus on broad diversification, low costs, and regular investing regardless of market conditions. But here's where timing becomes crucial for 2025 and 2026. We're potentially at an inflection point in several major economic trends. Interest rates may have peaked and could start declining. Inflation, while still elevated, appears to be moderating. Geopolitical tensions remain high but may not escalate further. These factors will significantly influence which investments perform best. If interest rates decline significantly, both REITs and growth stocks could see substantial appreciation. Lower rates make it cheaper for real estate companies to borrow and expand, and they make high-growth stocks more attractive relative to bonds. Gold might also benefit from lower rates, as the opportunity cost of holding non-yielding assets decreases. If inflation resurges, real estate and gold would likely outperform stocks and bonds. Real assets tend to maintain their value during inflationary periods, while financial assets can struggle. However, sustained high inflation could also lead to even higher interest rates, which would create challenges for highly leveraged investments. If economic growth remains strong, stocks and stock-based mutual funds would likely be the best performers. Corporate earnings would continue to grow, justifying higher stock prices. Real estate would also likely perform well in a strong growth environment, while gold might lag as investors favor growth assets over safe haven assets. The most likely scenario for 2025 and 2026 is a mixed environment with moderate growth, gradually declining interest rates, and continued but manageable inflation. In this environment, a balanced approach makes the most sense. Consider allocating 60 to 70% of your portfolio to diversified mutual funds, 20 to 30% to real estate investments, and 5 to 10% to gold. But remember, the best investment strategy is one that you can stick with through market volatility. Don't chase last year's best performing asset class, and don't abandon your strategy because of short-term market movements. The investors who build lasting wealth are those who stay disciplined and maintain a long-term perspective. Your specific allocation should depend on your age, risk tolerance, and financial goals. Younger investors with longer time horizons can afford to take more risk and might emphasize growth investments like stock mutual funds. Older investors approaching retirement might want more emphasis on income-producing assets like REITs and dividend-focused mutual funds. The most important thing is to start investing consistently, regardless of which specific investments you choose. Time in the market is more valuable than timing the market. Whether you choose gold, real estate, mutual funds, or a combination of all three, the key is to begin building your wealth systematically and stay committed to your long-term financial goals. As we head into 2025 and 2026, remember that successful investing isn't about predicting the future perfectly. It's about positioning yourself to benefit from multiple potential outcomes while protecting against catastrophic losses. The combination of gold's insurance properties, real estate's inflation protection, and mutual funds' growth potential gives you the best chance of building wealth regardless of what the future holds. The question isn't which investment will be the absolute best performer in 2025 and 2026. The question is, how can you build a portfolio that will serve your financial goals regardless of what happens in the markets? Start with that question, and you'll be well on your way to investment success. Knowledge without action is powerless. First, show your support by hitting that like button, then subscribe and turn on notifications. Most importantly, take action on the strategies we discussed today and share your results in the comments. Let's take another step toward financial freedom together.